Okay, so we're continuing our discussion about this is now in chapter number 17, Mutual Fund Dealers Regulation. So let me share my screen. So the steps in opening the mutual fund account. So here we have, when you're opening a mutual fund account, first of all, you have to provide the client with written disclosure. Usually, of course, that's going to be a printout of the account opening information, that what type of account they're opening, so they know it's a RSP or a TFSA or what type of account it is, and description of the products that you can offer. For example, if you're not, so you will not be offering any stocks or bonds. You're not licensed for that. You can only offer mutual funds, right? But you need to know about stocks and bonds because the mutual funds have stocks and bonds in them. But you are not going to be offering them any of those products. So you have to tell which products you're offering them, and how the dealer will procedures for handling of cash and checks. So if they deposit cash, you have the right to ask where is the source of funds. Banks don't like to take cash because there's no track record. You don't know where the money's coming from. So how if you're depositing more than a certain amount, usually the bank will report it to FinTrack. And checks, usually there is a check deposit. If they deposit a check, then there will be a hold on it. What is the procedure for that? So people, unfortunately, they do things with checks also. So that is also there. Then description of the obligation to ensure each order is accepted or any recommendation made to the client is suitable. So you have to make sure that everything is suitable for the client, right? And then circumstance in which the suitability review will be made like for mutual. So if there's any material change, so the client should know if they change happens, like their risk tolerance, or they have net worth changes, or their income changes, they should inform the company, or before they do any trade, they need to update the KYC regularly. And client reporting. So generally, uh, like if they're going to get their statement annually or every couple of months, 3 months, 4 months, so that also needs to be informed. And then description of nature of compensation. So whatever fees there are, that has to be disclosed. Of course, clients should know this is the MER you're paying annually, or if there's any fee for that account, or there's a front end load or a back end load that has to be informed there, or there's a trailer fee. And overall, the benchmark, what type of benchmark is going to be used for assessing the performance. So the benchmark should be relevant to the mutual fund, and that should also be informed to the client. So there's an order form. Obviously now it's all in the computer. Before it used to be you have to write it out, the order form, but now it's just enter the information about, of course, the unit and the shares or shares of the mutual fund. So you have to make sure you have the right code. Every mutual fund is like a code, and you need to make sure that you put in the right information. Um, So if the client does not give the KYC information, if the client says, I'm not going to tell you my date of birth, I'm not going to tell you my address, then the KYC is not completed, then you cannot accept the order form, right? You must get that information. Obviously now in the computer system, if you don't enter their certain information, you cannot do the trade, or you have to explain to the client why you need that information. Or they may just want to do short-term trading. There is a short-term fee also most companies charge if they trade like every 30 days. If within 30 days of depositing, they take the money out, then there could also be a short-term trading also fee. And this would occur for no load funds because there's no fee attached to that. Some people do that for that purpose. To prevent this, they have fees. So usually, like we said, usually short-term fees are there. For example, less than 30 days, they could charge 2% fee. So they usually want you to keep your money in for a long time. So that is possible. So for new accounts, there's a new application form for each client, and KYC is included in there. And then there's new account application. So the types of accounts we talked about at the start, I told you it could be RSP. Then if it's an RSP, they should name a beneficiary, because if they die, otherwise it goes to the estate account. and then there's fees for putting money into the estate account and other stuff, other fees. So it's better they should have a beneficiary. Usually spouse will leave the RSP to the other spouse. That is normal. They have to, it should go to the other spouse. Joint account, all parties must have identical time horizon, risk tolerance, and investment objectives, and KYC information is obtained from all the account holders. So if it is joint, if there's a husband wife, let's suppose one of the spouses has a lot of high risk tolerance, other does not have a risk tolerance, then you need to fill out two KYCs for each of them and give the appropriate right advice. It could be tenants in common, each party owns a prorated portion of the account, or corporation, estates and trusts, partnership, group plans, minor accounts, they should be placed in the name of the parent. So if it's a minor under it, every province has their own designation of minor. Like in Ontario, it's 18. In other provinces, different. So if the client is less than 18, it's a minor's account, and then you have to open up in the parent's name, and then the minor becomes older, then they can take over it. So, or it could be guaranteed by the parent. There could be investment clubs also. Investment club is people get together and one person has experience and knowledge in investing. They are going to invest money for the from the other persons into investment club. There's schools, boards. So companies can also have an investment account. A lot of companies have a lot of cash available. For example, churches and school boards, they also have money available and they need to invest it. So they need to open a corporation account, and in the corporation account, you need to get who are the shareholders, who are the board members, and who has the right to authorize the investment. So it's a little different when the corporation has to do it. So account opening is done in person, but now of course you can do it on internet, on the phone also. It's recorded. Of course, you need to get the full name, permanent address, mailing address. Social insurance number is required for the registered accounts, date of birth, and if you're paying a referral fee, you have to inform the client about a referral fee if you're paying that to somebody else for their account. And anytime they change their information, the KYC information must be recorded also. Sometimes there are nominees. So there's one is client name security, and there's nominee name securities. Client name security is of course the person's name is there. Other time it's called nominee name account. So what happens is the mutual fund company buys mutual funds and they just create a nominee name account saying this person has so many units. They do not transfer the ownership of the mutual fund to that person. It's just a nominee. And so they are entitled to act on behalf of that person and to facilitate processing of the transaction. And so this is known as a nominee account. And so some companies use that. They don't have to then, it's much more cheaper for them. They don't have to pay the money expenses to transfer the ownership. Every day, there's millions of units being sold and bought for the mutual funds. So nominee account makes it easier for them to keep track. What is prohibited? So this is very important. Usually you will get a few questions on this because they may want to make sure you don't do these things. A repurchase offer. You cannot say to the client, buy this mutual fund. If it goes down, I'll buy it back from you for the same price. Like if they put in 10,000, you say, don't worry, if it goes down to 9,000 or 10 or 9,500, we'll sell it and I'll pay you back 10,000. You cannot do that to give them like an insurance from the downturn. Quoting a future price. So that's why we said whatever price it is, you cannot say that what price you will buy it at because you don't know the price until the next valuation date and there's a waiting period. So you cannot quote the future price for the client. You will say this is the price on the closing day and we'll have to see what it is on the next day, and usually it's maybe 5, 10, 15 cents difference. You cannot make a sale without being registered. Of course, you must be registered. You cannot advertise a registration. So you cannot say that you cannot put on your board like I am registered with Investment Dealers Association or the for MFDA. That registration cannot be advertised, but you can just show that I passed the IFIC exam. That you can show, but you cannot show your registration. Trade name. So if you want to use your name different from what is your legal name, you can use the trade name, but it must be approved. So if your name is different on your driver's license or your legal name, and you want to use some other name, you have to get approval from the company also and from the Mutual Fund Dealer Association. Provision of non-monetary benefits. You cannot give gifts to the client for making them buy your mutual funds. You cannot give them like special incentive for that purpose. Non-monetary benefit. You cannot guarantee a future price. You can't promise any returns. This made 10% last year. I promise you it's going to make 10% at least this year. You can't do that. There's no guarantee on the future performance. You can only show historical performance, and you can show them like when the market went down, how did this behave, and this can this will probably behave the same way in the future. You cannot sell to any client outside of your province. You get a provincial license for Ontario. If the client is outside of the province, you cannot sell to that client within that region, other region where you're not registered, or you need to get registration in that area. You cannot sell other securities which you are not licensed. You cannot sell stocks, bonds, or other securities like that. Yes, any question about these prohibited sales practices? These are very important. Are they clear?
Yes, there.
Okay, good. All right. Yes. What are your other legal responsibilities? So, a lot of complaints, of course, come through different things. You need to know about PIPEDA. PIPEDA is privacy. You cannot share information about one client with another client, their investment account, their information. You must keep it secret. PIPEDA does not allow that. You cannot provide, for example, even between spouses, if they have sole account, you cannot share that information. So you need to protect that information. It requires the firms to you need to get consent from the client when you get their personal information. You obtain their information. You let them know I'm using this information for investment purposes and not for any other purpose. And if they need to change the information or they want to, and you must collect it by fair and lawful means, and you must not have like any personal relationships with the clients and all that. So this is private in terms of the investment aspect. Electronic commerce and everything is electronic, so you must make sure that information is kept safe when you're talking to clients on the phone or through email, through faxes. You have to make sure electronic consent is there. If the client consents to you sending email to them, or if they want to make a order and it is through email, you have to get their consent for that. KYC is know your client. Of course, we said you have to understand their situation. Terrorist financing, if money is coming from any terrorist group, you have to make sure you are aware of that and report that. So FATF is this is international. There's different governments. They cooperate, intergovernment bodies to inform about money which is being transferred worldwide in different countries and terrorist financing. So they publish a list of countries which are non-cooperating, and they will add or delete from the list annually. So they review the mission every 5 years. And they share information if somebody is transferring their money from between different countries. So you have to report any suspicious transactions. You have to verify if you feel the money is coming from illegitimate sources, and if there's $10,000 or more in cash deposited to the account, you have to report that. That is through FinTrack. Usually, some banks even lower amount. If somebody's putting $2,000, then that can also be suspicious, and that may also need to be reported. So, account opening process for a new client, you would conduct a client discovery. First of all, you understand what is the client, overall interview to learn more about the client. You complete the new account application form. You will also go through the advisors, dealer member. So sorry, you open up the account, you understand the client information, you complete the information online, and usually you will get approval from the uh, BCO, branch compliance officer, and all. Sometime you don't need approval, but if you are like in training, then you need to get approval first from the branch manager when you're opening an account to make sure all the KYC and everything is confirmed. And then client may place the first transaction also. Um, so they may do that also. Then they can do that application. And then new account application form protects both clients and dealer members, and clients are protected by having professional advisors know what investment is best suitable for them. So that is, of course, obviously. So your legal requirements are to open the account accordingly and get approval, and then they can do the trades. Okay, and then so rules of communication. Of course, sales communication should not mislead a client. So, like I said, you cannot create your own sales communication. You must use the fun facts which is provided by the company. It has the disclaimers and everything, and its proper information is reviewed by compliance department. You should not make your own charts and graphs or other information about performance, and do not make any false statement. Don't hide information about if it went down and you don't inform that, right? So, and it should be consistent. Whatever information you give should be whatever is in the fun facts and the prospectus. So there may be complaint, it may go through, there may be against a regulated person, or it could be client may request through through the company for redress of it. There's now a new, like, not new, but recent client relationship model, CRM. Basically, here there's two components. One is streamlined license requirement for all financial service providers, and there's a set of business conduct standards which are undertaken to make sure all the disclosure is clear and everything. So this is more recent CRM model that is being used. And CRM model, basically it is overall harmonized registration process. That's so there's phases. There's first phase and there's another phase also, two phases in the CRM. And the next phase is to involve the objective of allowing customers to understand what it costs them to invest. So the cost for investment in terms of the fees and the DSC and the front end fees, those are also, those need to be informed to the client. And all client complaints must be in writing, must be responded to in writing, and it must be handled by a qualified person. Regulated person must examine every complaint, not those just with violation. So, and they must keep records of complaints in writing. Okay, so yeah, that's the end of this chapter. Yeah, a little bit, this chapter is a little more boring, I think, but we had to go through it. So, yes, how do you guys feel more confident? At least we've done about half the course. Is that hopefully more clear? Any questions so far before we go to the next section? Yes, any question? Okay, so let's, I haven't sent this to you. I'll send this to you guys. The next section also, let me bring that up here. So chapters, these are till the 17, and the next one is going to be the other ones here. Let's bring those up. Okay, sorry, put that up. Yes, are you guys feeling more confident? Are things more clear now?
Yeah.
Yep.
That's good. That's good. Okay. Next, this one. Okay, so we did chapter 17. So next, what we're going to do is we are going to go through. Um, yeah, at the end, I'll send you these also. Print this up. Okay, sorry, it's a big file that's coming up. Okay, there we go. Chapter 16, 17, and 18. I think what we'll do is we will again jump a little bit. Okay, ethical standards. I guess we can do that also. Yeah, let's do that. Okay, chapter number 18. Let's do that also while we're at it. The ethical standards, applying ethical standards to it. So let me share screen. So, code of conducts. There are five primary ethical values which are outlined in the code of conduct. So, this a lot of things are quite obvious, but still you need to know them for the exam. Use proper care and exercise independent judgment. That is what we're saying is basically you are making sure that you are following the client. Um, so we'll talk about these in more detail next slides, but that is like the duty of care, trustworthiness, professionalism, that comes under duty of care, and conducting yourself with trustworthiness and integrity. And you need to keep an eye on your colleagues also, that they are acting in a professional manner, and know the rules and follow them, and make sure client information is confidential. So these are the standards of conduct in the code of conducts, and usually there's a few questions on this. They want you to make sure you know them, and they're a little bit tricky. They're a little bit like they do overlap, but uh, so duty of care, trustworthiness, professionalism, conduct in accordance with the securities administrators, and confidential. These are the five standards for the code of conduct. So we're going to talk a little bit more about each of them. First is know your client. So duty of care. So under the A, the first one, there is this one KYC. Duty of care is KYC. So you have to learn the essential facts about the client before developing and implementing the recommendation, of course. And due diligence. So due diligence is you are making an effort to understand the client and understanding the product. So you keep yourself knowledgeable about the economy, what is happening, and so you do due diligence is there. Okay, so that is the main thing for the duty of care. Then trustworthiness, honesty, and fairness. Under here, basically, how to build trust. There's two main things. One is competence and integrity. Trust is so you need to know your product also, right? If you don't know about mutual funds and you tell the wrong things to the client, they will not trust you because what you're saying is doesn't make sense. It's not the correct information. So your competency is important to develop trust. And number two is integrity, of course. You do what you say, and you are fair in there in making them understand your information. So that is integrity. So integrity and trust, they both are going to integrity and competency. They will create trust for you for your building trust with the clients. So priority of client's interest, you do what is good for the client. You don't like give them advice for which you have more, you're going to get more um, commission or more benefit. You respect the client's assets, their money. You treat it as if it's your own, and you complete all the information related to the client accurately and properly. And you disclose any conflict of interest. If you are going to get a special benefit from their investments or from recommendations, you need to disclose that to the clients. Professionalism. So here we have duty centers on the role of fiduciary duty. Fiduciary duty means, again, this is also a little bit repeat from the previous, but more is that you are going to advise anything which is you always are going to keep the client first when you make any recommendation, right? You have so you really have requirement to, you want to look out for the interest of the company and the interest of the client. But interest of the client is first always. So act as an agent, as an advisor to the client, and the client is the principal. They are going to trust the advisor. So fiduciary duty means that you've center on that. That is your professional conduct. And then conduct in accordance with securities administrator, obviously know the rules, follow the rules. If there's any legal compliance issues, you will get clarification from your BCO branch compliance officer or others if you are not sure what to do. And the main thing is that the registered individual, they can't say I didn't know, right? That's not a good excuse. You need to know about the rules and you need to follow them. So that is, of course, the things there. And keep yourself updated. The rules may change also. Confidentiality, main thing is to keep information confidential and don't share any client information, of course, on internet or with other clients without their consent, right? So that is also important. Yeah, those are mainly that. I mean, that chapter is just basically, there's some case studies there, read through those examples in there, but the main things are all related to those the examples they gave you there. That is what they mean, that you should be aware of these aspects, right? Here, any question on that? That's an easy section, but um, so now I'm going to come back to the first. Let me bring that up here. This one. Now what we're going to do is we're going to jump back to the, yes, chapter number one. I'm going to go back to chapter number one now. Before we so next, what we're going to do is tomorrow, it's Saturday. So tomorrow Saturday we will, I'm going to start out on the calculations tomorrow. Okay. So tomorrow come prepared with, I'm going to start going through some of the calculations we talked about before already. I'm going to give you a worksheet and we will go through those calculations. um, and so that will start out tomorrow, and then we will continue our other discussion also. um, there's going to be more calculations in the tax and retirement planning. I want to go through that tomorrow also. So we'll start out actually on tax and retirement planning and do the calculations that we already talked about, but we didn't do yet. And then we will cover the rest of the course also in on Monday and Tuesday. And that's it, right? So then we would have covered everything. So today, we have about 20 more minutes. Let's go through this and then we will stop there. So chapter one, roles in mutual fund sales rep. This is just history. Usually they don't ask you much about the history, but basically, like 1890s, at that time, there was of course no computers, just fixed trust first investment funds were available. 1900s were closed-ended funds. Closed-ended meaning you put your money in and it's locked in. You cannot take out your money. And usually, of course, companies invested in it. 1920s, the open-ended mutual funds came, and they were always available from fund companies to meet investors' needs. In 1930s, the first three mutual funds opened, and recently now there's a lot like 1.4 trillion dollars in assets. There are more than 2,000 funds here in Canada. So there's lots of like options now for clients. So why do you want to get licensing? So you will be able to sell financial products, and of course you need to be registered. And there's also continuing education. Once you get registered, there is a continuing education also requirement. So to provide the good customer service, you have to know your client, know their risk tolerance, know their time horizon. You have to know your products, like we talked about, and ensure the client only buys the suitable mutual funds. And you need to follow up with them also on it.
Are we supposed to see a screen? Because I
Oh,
can't
I'm
see it.
sorry. Thanks for mentioning that. I'm sorry. I didn't share the screen. Oh, sorry. Let me share screen again. Sorry. Thanks for mentioning. So yeah, I just went through these slides here. Yeah, this shows the evolution of the mutual fund industry. I will share these slides to you also as soon as we're done. So this is the timeline, and this I mentioned value of licensing here also, and then to provide the customer service. So this I was mentioning, know your client, know your products, ensure the client only buys suitable mutual funds, and then follow up also. So three responsibilities you have. There's legal, they're only allowed to sell the suitable products. And then ethical responsibility, put the client's interest first. And then professional responsibility, provide the best service based on the concepts we just talked about, the ethical, professional aspect. You have to due diligence and also fiduciary duty and all that other stuff. So compliance, ethics, and fiduciary duty. Compliance means you follow the rules. That is compliance. So there are written rules, black and white, which are clear. Those are their legal requirements and dealer policies. So you must follow those, right? And ethical conduct is you comply with the law and the spirit of the law. That is ethical. So some things are not written down. That is ethics, moral principle, like don't steal your client's money and don't, other stuff like that. So that is more ethical conduct. And then fiduciary duty is you put the client's needs before your own. That is fiduciary responsibility or fiduciary duty. So these are things you should keep in mind. Now more about the KYC in your book. They mention a lot of different things. I made a summary here. What we mean by KYC and very important. So there's first of all there's personal information, then there's financial information of the client, and then there's investment. So for personal information, you have to ask the client, get their ID, what is their name, their address, are they single, married, what is their personal aspects. You need to put that information there. Their financial, their income, how much income are they getting from their job, what is their net worth, in other words, assets minus liabilities. That is the financial aspect. So you need to know, is this the only money they have, or do they have other investments? Uh, if they are doing a monthly deposit, do they have enough money to sustain that? What is their investment? So investment aspects, TORK, just a summary you can keep in mind. Four things you need to ask regarding the investment. T is for time horizon, O is objective, R is risk, and K is knowledge and experience. So by T, we mean time horizon, basically when do you need the money? If they are retiring at age 65, they're not going to take out all the money all at once. They're going to take it out over like 10 years or some time period, right? So time horizon is when do you need the money, right? That is based on T. O is objective. What is the objective? There should be safety, income, and growth. Um, so, what is the purpose of putting the money in? So, we're going to, yeah, we'll talk about that a little later. Yes. So, the safety is, of course, I don't want to lose any money. That is a safety objective. Income is I need to supplement my income. I need $500 a month every month to supplement my income. That is an income requirement. Then growth is I have $5,000. I want it to grow to $6,000 within a year. That is a growth objective. So what is the objective of the investment? Why are they putting the money in there? What is their risk tolerance? So how do they feel if the value of the investments went down? How would they feel, right? So that is also our objective there for risk tolerance. Key is knowledge and experience. Knowledge is different from experience. Knowledge is just they know about it, they maybe read about it, and that's it. And experience is did they really ever buy mutual funds? Did they buy these products? And that is the key aspect, the knowledge aspect. So two things. One is KYC. You need to know about the client, right? The second thing is know your product. So this whole course, the purpose of this is you know about the product, what are the investments in, if the market goes up or down, like we saw there, you remember in the bond fund, the stock market went down, the bond fund really did not go down, right? So the bond market does not follow the equity market. You need to know that, and also like equities, if Toronto Stock Exchange goes down, the investment will probably go down. So they need to be aware of that. Sales charges, how much fees are they paying? What money? If you put in $10,000, what is your fee for the whole year? So they need to know that sales charge, MER, right? Annual fees. If there's an annual fee that the funds will charge, what is that? The MER. Sales charge, sorry, is if you're buying or selling. Annual fee is the MER they have to pay, which is going to be minus from their returns anyways. conditions and costs when buying and selling the funds. So what is the situation if they're going to buy and sell the funds? What are the conditions and costs if they sell, is there a deferred sales charge or not? The type of income. So, okay, so what are the three types of income funds can generate? Who wants to tell me what are the three types of income?
Dividend,
Yes.
capital gain, and interest.
Perfect, exactly, yes. Right? So those are three types of income, and is this fund, can it get that type of income or not? That is your know your product. So suitability, so these two things, if you know about the client, you discussed all this about the client, and you also know your product, then you can give a suitable recommendation. So suitability means that you are giving a recommendation based on the client's own personal financial circumstances. You understand the client's needs, their time horizon, and you understand the asset allocation model also. Um, you understand what is their like the mutual fund that you're recommending, what is it invested in. It applies to both solicited and unsolicited orders. So like we mentioned, solicited order is where the mutual fund rep and the client, they both agree, they both have the discussion and they agree that we're going to invest in this type of fund, and that's a solicited order. Unsolicited order is the client just comes in and they give you an order, I want to invest in this mutual fund, and that's it. That's an unsolicited order. If the unsolicited order is unsuitable, we mentioned already, there's an obligation to refuse the order. You should refuse the order, otherwise you could be in trouble later on. So suitability, we said, is both KYC plus KYP. Then you can give a suitable recommendation. What is the meaning of asset allocation? It means diversification. Spread your money around into the different asset classes. So that's why I started out to make you first understand what are the asset classes. There are three main asset classes. There's cash, which is money market. There's fixed income, which are the bonds and GICs. And then there are equities and shares, which are preferred and common shares. So you need to discuss with the client, understand what are their needs, what are their situation, KYC, understand about what are the different products available which is suitable for them, and then tell them we're going to invest in the balanced fund, for example, and in the balanced fund, so much percentage is in bonds, so much percentage is in stocks, and this is the benefit. So this is the asset allocation model. So you should be able to explain that to the client, and then you are giving a suitable advice to the client. Any question about this suitability? Yeah, this is quite important. They usually have a few questions on suitability and KYC because you have to follow through with that every day with the clients. So mutual fund sales rep, they help the clients obtain suitable mutual funds based on the KYC information. Your responsibility is to get the information and see if there's a suit, if it's judge if it is a fit or unfit, and if it's not, there's alternative also there. You can only discuss about mutual fund products and GICs which are offered in the banks. You cannot recommend any stocks or shares or bonds or give any advice on it. If you do the CSC and the CPH, then you can become a financial advisor and advise in stocks and bonds. But of course, this course is only for IFIC. If there is an incomplete KYC, you must refuse the order. You cannot accept that order. If it is a complex case where there's budgeting or insurance needs or estate planning or other stuff, then you should refer to a senior person, a financial planner, and they will take care of the client. Okay, that was it for chapter 1. Chapter 2 is overall overview of the Canadian financial marketplace. So what is investment capital? So investment capital is any money which is being used for investment purpose, right? So that is extra money. So the decision to the location, okay, actually, let me just see here. I think okay, we can do that. 6 minutes, I think. Okay, let's finish this up in 6 minutes. I think we can do that. Okay, so investment capital, we said, is you are going to look at the flow of capital. That is, if money is coming in, that is the investment capital. When does money come into a country? When there is good fiscal policy, that is, government manages expenses and taxes. If there's a good monetary policy where there's effective management of the country's cash supply, when the political environment is good, there's a lot of investment opportunities. You have to see what is the economic trend. All this information is on the internet, available on the government websites. What is the rate of inflation, gross domestic product, um, what are the value of the services and goods in the country, in the labor situation, what is employment, unemployment. All these things, they affect the overall flow of capital. If everything is positive, then capital will flow into the country. If it is in bad supply, if there's not good news, then money will go outside of that country, right? So capital moves around in the whole world. um, and capital saving is direct use, like investment resources into a home, or the investment of government on roads. So government also is a big investor, right? The government puts money into different infrastructure. Government issues bonds and other investments to get money from the investors also. So who provides capital? We have retail investors, institutional investors, and foreign investors. They are the ones who are providing the capital, right? So we, as consumers, we have some savings with the banks, that adds up. Then mutual fund companies, they also have a lot of money available. And then there's also pension funds. Pension funds have a lot of money saved up, which is pension money from the different companies. And then there's also insurance companies. They have a lot of money saved up. So all that money, and different corporations, they are capital sources. And then there are foreign investors. Provincial government, we said, they issue bonds, which may be issued to the federal government. Funds may be borrowed from the CPP. So CPP is Canada Pension Plan. As you know, that is the government pension plan, which is minus from your account, and you have a pension plan. So you deposit money into the CPP, and the employer also contributes to CPP. So there's a lot of money in the CPP fund, and so the debt may be issued domestically, or it may be issued outside of Canada. And who uses the money? The governments, the businesses, they use the money. Government uses money for infrastructure, business use money for expansion, buying other companies, and individuals use the money also, right? So this is all about investment capital. We already talked about these different. There's bills. There's so Canada Premium Bonds, marketable bonds. So some companies and also the governments, they issue the bonds and debentures and all. We already mentioned this last time, but what are the financial instruments? There are debt instruments like the T-bills, commercial paper, bond. Those are your debt instruments. There are investment funds like the mutual funds. There are equities like the stocks and bonds, and then derivatives, which are more like they're betting on the price. They're gambling. They have an agreement. One party has an agreement with another regarding the investments. And then there are other investments also, like ETFs and linked notes and all. So primary market is when you buy directly from a company or the government. That is a primary market. When the stocks are issuing first time, it's called initial public offering. That money goes directly to the company or to the government. That is a primary market, right? And then secondary market are the stock exchanges. So we have 5 stock exchanges here in Canada. There's Montreal Exchange, there's Toronto Stock Exchange, TSX Venture, the ICE Futures, and the Canadian National Stock Exchange. So these are the different exchanges here, and those are secondary market. There, the investors are trading between each other. The investors are so that all that trading, the companies do not get that money. That money is just between the traders, and then the companies may issue more shares at a higher price, and then they can get more money from the public investors. So the secondary markets are those where it is traded between the investors. So sellers and buyers don't directly carry out exchanges, particularly in the financial markets. Other individuals do such for them. So mutual funds offer for sale in the primary market. So you do buy mutual funds from the banks, right, mainly, or the investment companies, but the stocks are issued in the auction market, and the auction market are the stock exchanges. So we said Toronto Stock Exchange. There they have senior equities, larger companies, and a few debt instruments are there also. ETFs, income trusts are also on the stock exchange. The venture exchange is for new companies. They first go on the venture exchange, then they go on the stock exchange. And Montreal Exchange is all the equities and financial options and futures. So these are private companies, so they have the right to issue shares, and take companies can register themselves there. So there are different companies like these, which are the financial markets. So last slide here is just about overall the second major kind of market where securities are traded out is over the counter. So there's two main markets. One market is your auction market, which includes all the exchanges. The second market is called OTC, over the counter. It's also known as unlisted market. They're not on the exchange. So these are the bond dealers and other markets where where buyers and sellers, they can put their information in there, and they can buy and sell securities. So nearly all the debentures and bonds are offered for sale on the dealer market, and you don't know, it's not that much visible on the dealer market. You don't know what the other prices are for the other products, and there's also volume for the dealer market. Considerably, this is bigger than even the equity markets. So the dealer market is also a huge market. Okay, so we'll stop there. So tomorrow what we're going to do is we are going to, sorry, so I think, so we've done half of it. I'll continue with this one, overview of the financial marketplace. So we'll finish this off. So I'm going to actually start tomorrow. We're going to go to chapter 6, taxation and retirement planning, because that's a big chapter. It's very important. We're going to go through that, and I'm going to start out going through some of the calculations. So that is going to be tomorrow. And then you will have time on Sunday to review the calculations. And then on Monday and Tuesday, we can then go through the rest. We have to still do chapter 13 also, alternate managed products. We also have to do economic principles, KYC, behavioral finance, a little boring. We have to do investment portfolios and the financial statements also. We have to do those also. So that is the plan for the next sessions. I will send you these slides also. Any question before we sign up?
No, that was a good session.
Okay.
Detailed and good.
Yes.
Thank you.
Okay.